So we're covering Chapter 1 for Principles of Accounting 1. And in this video, we're going to talk about ethics, accounting principles, and GAAP, G-A-A-P, or Generally Accepted Accounting Principles. Accountants are required to follow an ethical code. And if they do not follow an ethical code, they can actually lose their accounting license and be barred from practicing accounting. Ethics distinguish from right and wrong. They are accepted standards of good and bad behavior. What is wrong? What is bad? What is good? They can also be looked at as how well we are interpreting the laws and regulation of accounting. Many of the laws and regulations of accounting are open to interpretation. This is where fraud happens, as we're going to talk about in the next slide. So it's important that accountants are supplying useful and trustworthy information, especially since people are making decisions based on this information. This is the fraud triangle, the accounting fraud triangle. The fraud triangle consists of three different components: opportunity, rationalization, and pressure. All three factors have to exist in order for a person to be able to commit fraud. First is the opportunity to commit fraud. This means that the person is able to commit the fraud with a low chance of getting caught. Either they are in control of account, they have the ability to write checks without having to check with anyone else, or to spend money without having to check anyone else. A lot of the opportunity comes from, do you have to check in with someone else, or are you able to make all of the decisions without anyone checking your work? That's where opportunity comes from. Rationalization. This is where we tell ourselves it's okay to commit the fraud. We need to do it. A lot of the time when we talk ourselves into rationalization, there's some kind of a pressure. So that pressure to commit fraud. I need money. Some of the fraud cases that I've come up against, in one example, a guy was committing fraud. He embezzled almost $100,000 from his company, and his mom was sick, and he was using the money to pay her medical bills that he was stealing from the company. So that pressure, needing money, and then rationalizing it. Well, if they just paid me better, I would be getting this money anyway. They owe me this money for some reason. So the rationalization is your ability to talk yourself into committing fraud. We're going to talk more about the fraud triangle in Chapter 6 when we talk about the rules and regulations that companies must follow to help prevent fraud. Generally accepted accounting principles, or GAAP, also sometimes called U.S. GAAP because they are U.S. accounting rules. There are different rules for international accounting, but generally accepted accounting principles are the general framework and regulations that accountants and accounting information has to follow. So we see here that they can change over time, and that is because there is a governing body called the Financial Accounting Standards Board that sets generally accepted accounting principles, and they can be changed when there are different rules changes. They can also be changed by different law changes, and they can be changed by accountants who are working in the field who can appeal to FASB or that Federal Accounting Standards Board to change the laws. The main rules are that information is relevant and faithfully represented. So any information that a person needs to make a good decision is available to them, and you're not giving them a whole bunch of extra information to confuse the decision. And you're accurately reflecting your business results. You're not trying to hide anything from the people that you're reporting to or sharing information with, and you're not trying to commit fraud by giving them misrepresentation of data. FASB, that Financial Accounting Standards Board that I talked about, who creates the accounting standards which then become US GAAP. Their authority is provided by the Securities and Exchange Commission, who we're going to talk about on the next slide. So the Securities and Exchange Commission, the SEC, is a governmental agency that establishes accounting principles and financial reporting requirements for publicly owned corporations. A publicly owned corporation is a company that sells stock on the New York Stock Exchange. So the SEC regulates companies that sell stock on the New York Stock Exchange. There are thousands upon thousands of small businesses and mid-sized businesses around the U.S. that do not sell stock. They do not have the same accounting rules and regulations that corporations who sell stock do. They do have some similar ones, but they don't have all of the same ones. A lot of the accounting that we focus on is corporate regulations. And then the International Accounting Standards. International Accounting Standards are actually called IFRS, so the International Financial Reporting Standards, and they are created by the International Accounting Standards Board, or the IASB. There is some overlap between the International Financial Reporting Standards and US GAAP standards, but there are also some significant differences in a couple of places. So if a company is a US-based company and reporting in the United States, they have to follow US GAAP for their reporting requirements. If they are also operating internationally, then if they're reporting in those countries, they have to follow international financial reporting standards. It can be a lot of work for companies to have to follow both rules, especially when the rules vary between the two main bodies. So now we're going to talk about accounting conceptual framework. So what are the different things that we're looking for when we're making accounting rules and regulations? So what is the objective? Well, the main objective is to provide good information to the people who need it. So people who are investing in the company, people loaning money to the company, etc. That the information is relevant, faithfully represented, there are no fraud or ethical violations. We are explaining the items within our financial statements. We are presenting our financial statements faithfully. And we're using recognition and measurements. So this is the criteria for how we recognize information in the accounting system. Next, we're going to talk about the different principles that we have to follow as part of that recognition and measurement. Okay, so we have principles, assumptions, and constraints. So general principles are assumptions, concepts, and guidelines for preparing financial statements. And then we have specific principles, which are the rules that are used for reporting business transactions. So that's when we get into those journal entries. In Chapter 2, we're going to be talking about those very specific principles. So let's look at these items one by one. Okay, so the first is the measurement principle. So the measurement principle is also sometimes called the cost principle or the historic cost principle. This says that we record accounting information at the actual cost. So if we buy an item and it costs $100, that is what gets reported on our financial statements. It doesn't matter what the actual market value of that product is, we have to record it at the exact amount that we paid for it. Okay. Then the revenue recognition principle. This says that we can recognize revenue when goods and services are provided to customers. So what this says is that if we have a contract to build a house for someone and they pay us up front, we can't record that as a sale or as earned revenue until we actually build the house. We have to deliver the good or service before we can actually record that cash received as revenue. We're going to address that further in Chapter 3. The expense recognition principle says that we have to match expenses to revenue. This is also an accounting period rule. So if we earn revenue in January, then we need to record all of the expenses that occurred in January that connected to that revenue. And again, we're going to talk about this a lot more when we get into some of those journal entries. Full disclosure principle means that we report any information that could impact users' decisions. When we get into the different chapters where we talk about the different components in the financial statements individually, we'll talk a little bit more about some of those reporting requirements that would be required under this full disclosure principle. We have various accounting assumptions. So the first is the going concern assumption. Under this assumption, the business is presumed to continue operating instead of being closed or sold. This means that we operate under the assumption that the business is always going to continue forever. Monetary unit assumption is that transactions and events are expressed in a single monetary unit. That could be the US dollar, or it could be another international, like a euro or pounds, or wherever the company is reporting in. If they're reporting in the United States, they generally use the US dollar. The time period assumption, which means that accounting information can be broken down into time periods. Months, quarters, so a quarter is 3 months and there are 4 quarters in a year, or a year. And then the business entity assumption, which is that a business is counted for separately from other business entities, including its owner. So the business is separate from its owner. And we're going to talk a little bit more about accounting principles and concepts in the next video.